Welcome back. Today on the Byte-Size Brief, we're going deep on Dakota Gold, ticker DC. Now, this company is making some serious waves, not in some new frontier, but in South Dakota's legendary Homestake District. It's a name that echoes with gold rush history, but it's Dakota's aggressive, forward-looking plans that have really caught the market's attention right now. So here's how we're going to break it all down. First, we'll get into their big bet on this historic district. Then we'll look at their clever two-project strategy. After that, we'll weigh the bull case versus the bear case, the good and the bad, and we'll wrap it all up by looking ahead to 2026, which is shaping up to be a make-or-break year for them.
All right, so to really get Dakota Gold, you first have to understand the ground they're standing on. We're not talking about just any random plot of land. This is the Homestake District, an absolute monster of a gold field that's already coughed up over 40 million ounces of gold. So you see, Dakota Gold isn't just starting from scratch. They are quite literally prospecting in a giant's footsteps. And this quote from their CEO, Robert Quartermain, pretty much says it all. It's the core of their entire philosophy. Why go out into the middle of nowhere and hope for the best? Instead, they're setting up shop in a world-class district that has a proven century-long track record. It's all about using that history as a launchpad. But, and this is the big but, here's the absolute heart of the matter. For all that amazing history and all that potential, Dakota Gold isn't actually producing and selling any gold. Not yet. They're what we call a pre-revenue developer, and that creates this huge tension for any investor. You're betting on a massive prize down the road, but you're also taking on the very real risk of a company that currently has zero income.
So you might be wondering, how does a company with that kind of risk profile even operate? Well, Dakota Gold's answer is a pretty smart dual project strategy. It's a plan specifically designed to do two things at the same time: build a path to cash flow for the near future while still swinging for the fences on a huge discovery for the long term. And this is what that approach looks like in practice. On one side, you've got the Richmond Hill project. You can think of this as their safe bet. It's a big, open-pit project designed to get them into production and get the cash flowing by around 2029. But on the other side, you have the Maitland project. This one is more like their lottery ticket. It's a much higher risk, but way higher reward. Exploration play that's hunting for a brand new, high-grade underground discovery. One project for stability, the other for that home run potential. Now that safe bet, Richmond Hill, really hinges on a process called heap leach mining. So what is that? Well, basically, it's a proven, cost-effective way to get gold out of huge amounts of rock that don't have a super high concentration of gold. This isn't some newfangled tech. It's an industry standard that's absolutely central to making the whole project work economically.
Okay, with that strategy in mind, let's put on our optimist hats and dive into the bull case. The whole argument here really revolves around this idea of a re-rating. That's just a fancy term for when the market completely changes its mind about what a company is worth. The hope is that as Dakota Gold keeps proving out its projects, investors will stop seeing it as just a risky explorer and start valuing it like a genuine future gold producer.
And any re-rating has to be built on a foundation of hard data. For Dakota Gold, the most important number right now is this one: 3.6 million ounces. That's what they call a measured and indicated resource at Richmond Hill. Now, in plain English, that means they have a really high degree of confidence that the gold is actually in the ground. This isn't a wild guess, it's a real quantified asset that the company's value is built on. So what could all those ounces be worth? Well, an initial economic study tried to answer that, and it came up with a pretty eye-popping number: an after-tax net present value, or NPV, of $1.6 billion. NPV is just a way of estimating the total profit of a project over its entire life, all in today's money. And what makes this number really interesting is that it was calculated using gold prices that were much, much lower than where gold is trading today.
And it looks like Wall Street is starting to believe in that potential. If you average out the price targets from the analysts who cover this stock, you get an implied upside of over 90% from its current price. That's a huge vote of confidence. It tells you that the professionals who study this company day in and day out see a ton of room for it to grow.
And we're not just talking about one or two hopeful analysts here. Just look at this. The consensus is completely unanimous. Every single analyst that covers Dakota Gold rates it as either a buy or a strong buy. I mean, you almost never see that kind of across-the-board agreement, and it really signals a strong belief in the company's story.
Okay, but it can't all be good news, right? Of course not. Now we have to flip the coin and look at the bear case. Building a mine from scratch is mind-bogglingly expensive, and for a company with no revenue, that money has to come from somewhere. And that leads us to the single biggest risk for investors: dilution.
This right here is the fundamental problem. You've got all these plans, drilling, studies, engineering, permitting, and it all costs tens of millions of dollars. So the question is simple but critical. When there's no money coming in the door, how do you possibly pay the bills? And the main answer is you sell more and more pieces of your company. This number shows you the real cost of that strategy. To fund their operations, Dakota Gold has increased its total number of shares by nearly 300% in just 3 years. Think about it this way. Your ownership slice of the pie just got cut into much, much smaller pieces. The company has to deliver on some truly massive growth just for your investment to stay level. And this little table lays out that financial reality in stark, black and white terms. In fiscal 2024, revenue was zero. They burned through more than $31 million in cash. And to help plug that hole, they raised almost $16 million by, you guessed it, issuing new stock. This is the cycle. Burn cash to create future value and fund that burn by diluting the very people who believe in you. So all of this leads us to what comes next. We have the bull case, we have the bear case, and now it's all about execution. 2026 is shaping up to be the proving ground, the year where the theory hits reality. There are several huge milestones on the calendar that are going to give us a much clearer picture of which story, the bull or the bear, is going to win out. So here are the key things to watch on the road ahead. Throughout the first half of the year, expect a constant flow of new drill results. These will tell us if their gold deposits are getting bigger and better. Then, in the second half of 2026, we get a huge one, the pre-feasibility study for Richmond Hill. This is a massive economic update that will be a major de-risking event. And finally, by the end of the year, we should get the very first resource estimate for that lottery ticket Maitland project. That will give us our first real glimpse of what they might be sitting on over there.
And all that leaves us with this one big question. The risks are obvious, but the potential reward is huge. With these massive catalysts just around the corner, we're all about to find out if Dakota Gold's modern bet on a legendary district is finally about to pay off. That wraps up today's deep dive on Dakota Gold. For a sharper, more candid discussion, join us on the full audio podcast. Drop your questions and takes in the comments. We read every one.